At some point, the economy is gonna slow down again. Companies, they will start reporting weaker results. Unemployment may rise and the market may fall. The same thing happened back in 2022. And when is it gonna happen again? Nobody knows. So the uncertainty is the reason defensive investing matters the most. So defensive investing is not predicting when there is the next recession. It is building our finances and portfolio so that when a difficult period comes, it does not forces us to sell what we have. And in this video, we will build that foundation using 4 areas: emergency cash, manageable debt, diversification, and businesses with durable demand. So starting with defensive investing. So here, I want to be clear about what defense does not mean. It does not mean that the portfolio will never fall. Consumer companies, healthcare businesses, utilities, bond, and broader index, they all can decline. The goal is not to remove all volatility. That is completely impossible. The goal is to reduce the chance that a market decline becomes a personal financial emergency. So starting with the one, why market timing is not a defensive plan. We all think and we all plan that we will sell before a recession and return when the market reaches the bottom. And it sounds very simple, but when you look at the chart in real time, it is extremely difficult. Economic data is somehow delayed. The stock market often begins falling before a recession is officially identified, and it may begin recovering while the news still looks very negative. The best and worst market days can also occur close to together, and a person who sells after a major decline may feel safer, but now that happens must make a second correct decision, and that is when to buy. So if the market recovers quickly, fear can leap and investors in cash while prices rise. And defensive investing should not depend on two perfect timing decisions, because you cannot be watching market all the time. So it should depend on financial structure that works even when our forecast is wrong. There is another reason timing is very difficult. The stock market and the economy are not the same thing. A recession describes economic activity. A bear market describes a market decline. They can happen together, but not always with the same timing. The market may fall because investors expect weaker condition months before economic reports confirm. It can also recover because investors expect improvement before people feel that. So improvement is in their daily lives. This is why waiting for a news to become comfortable and can mean return after a large part of the recovery has already happened. So a defensive plan accepts that we will not be able to follow up the market and we won't be able to entry and exit at the right time. It focuses instead on cash needs, diversification, position size, and quality of what we own. And the first pillar is emergency fund. And this money is not designated to produce the highest return. It is designated to protect the rest of the plan. It has been said that 3 to 6 months of expenses are useful goal for many people, while also noting that even a smaller amount can help. The correct amount depends on job stability, family obligation, insurances, so many different reasons. So why is cash connected to investing? Because the most dangerous combination is a falling market and unexpected need for money. So can you imagine losing a job during a recession while the stock portfolio is already down by 30%? The investor may be forced to sell shares at a bad time to recover rent, food, insurances, and medical bills. The emergency fund creates time. It allows person to handle short-term expenses without turning a temporary market decline into a permanent realized loss. So keep this reserve liquid and separate from long-term investors. It should not depend on the stock market being open or price being favorable. Emergency cash protects the investment plan from a real life emergency. And the pillar 2 is control high interest debt. So if someone is paying 20% or more on credit card debt, investing aggressively while carrying that balance can create a weak foundation. Paying down high interest debt produces a known reduction in interest expenses. So stock market returns are uncertain and can be negative for a very long period of time. For example, that happened during COVID time and back in 2008 as well. So this does not mean every form of debt must be eliminated before investing. A mortgage, a student loan, or a low rate debt may require different decisions. So the important point is that high required payments reduce flexibility. So during a recession, flexibility matters. Lower monthly obligation makes it easier to continue saving, avoid forced selling, and handle an economic interruption. Moving on to pillar 3, that is diversification. Defensive investing does not mean moving everything into one so-called safe sector. One industry can still face regulation, disruption, valuation risk, or company-specific problems. A broad index fund may already provide exposure to technology, health, financial, consumers, utilities, and other sectors. So a complete defensive allocation may also include bond or cash, depending on when the money will be needed. So for example, last year, tech sector faced a decline where Microsoft, Facebook, and all these companies, they lost up to 25 to 30% from its peak. So the current mix depends on investors' goal and ability to handle declines. Another important form of diversification is time. Money needed within 1 or 2 years should generally not depend on a stock market recovery. Long-term retirement money can normally accept more short-term volatility than a house down payment needed next year. So defense begin by matching the investment with goal. Diversification should also exist inside the stock portion. A portfolio with 10 companies may still be highly concentrated if 8 of them depends on same economic driver. For example, several software, semiconductor, and cloud companies may all benefit from AI spending. They're different businesses, but one slowdown in data center investment could affect many of them at the same time. And the same applies to banks exposed to the same credit cycle. Retailers depend on the same consumer groups, or energy companies depending on the same commodity price. So real diversification means understanding what can cause each holding to succeed or to struggle. Moving on to pillar 4, that is durable businesses, and that is understanding which businesses may have more durable demand than the others. When the economy slows down, people usually postpone some purchases. They may delay buying a new car, luxury products, or expensive vacation, but people are going to continue spending household products, groceries, medicine, and essential services. Procter & Gamble could be a really good example. It sells products such as detergent, diapers, razor, toothpaste, and all. So during fiscal year 2021, while the world was still dealing with the COVID, P&G reported organic growth of more than 6% core earning per share and a growth of 11% and e-commerce sale growth of 35%. That does not mean P&G cannot fall. It can still face high valuation, currency changes, commodity cost, private label competition, and execution risk. The example simply shows why demand for essential products can be more stable than demand for discretionary products. Another defensive characteristics may include recurring revenue, strong cash flow, manageable debt, pricing power, and products consumer continue using during weak economic periods. But we should also study the numbers. A company is not defensive only because it belongs to a defensive sector. A heavily indebted utility or overvalued consumer staple can still create poor returns. So when I research a defensive company, I check how did revenue and margin behave in previous slowdowns. How much debt does the company carry? The dividend covered by free cash flow? Can the company raise price without losing customers? Does the company have a strong balance sheet? For example, Costco provides another durable demand combined with different business model. Customers buy groceries and household products, but they also pay membership fee. Those fees provide recurring revenue and encourage customers to continue shopping at the warehouses. However, even a durable company can become a risky stock when investors pay an extremely high valuation if future growth is slightly weaker than expected. The valuation can fall even while the business remain profitable. This is why defensive investing has two separate questions. The first one is the business durable? Second, is the price reasonable? And a safe looking industry does not protect an investor from overpaying. Part 6, that is, keep investing but do not assume every decline is a bargain. For a long-term diversified investment, automatic contribution can reduce the pressure to predict the perfect day. When prices fall, the same dollar amount purchases more shares, but we should be very careful with the phrase everything is on sale. So a lower price does not automatically create value. If the businesses has permanently lost customers, taken on dangerous debt, or faced major competitive change, the lower price may reflect a real decline in value. For example, for a broad diversified fund, continuing a long-term plan may be reasonable, but for someone whose goal and risk tolerance have not changed. For an individual stock, we should first ask whether the original business thesis is still valid. Price down and value unchanged can create an opportunity. Price down because value is deteriorating in a different situation. For example, Rivian was the competitor of Tesla. However, they could not catch up with the production or with the debt or with the free cash flow. So with time, you will see that investors lost their interest and the stock price of Rivian is very down right now versus if you see at the Tesla stock. If you would go and compare company's revenue history, margin, debt, free cash flow, valuation and risk, you would know whether a company was actually durable in the numbers